Hi everyone, I'm Max Friar, founder and managing partner of Calder Capital, and joining me is Hannelore Jones, our director of operations. And we've been speaking recently and decided that we'd give kind of this impromptu update on the condition of the market and some things that we've seen change over the course of not only my career, but just in the past few years. And so Hannelore is going to be asking me a series of questions. Hopefully I'm prepared for them, and I'm going to try to give the best answers that I can to these questions.
Awesome. Yeah. Thank you, Max. So you've built Calder Capital into one of the Midwest's leading M&A firms with over 375 closed transactions. From your seat overseeing the volume of deal flow, how would you characterize the current state of the middle market and the M&A landscape? And then what's different today compared to even 2 years ago?
Yeah, I mean, that's a lot to unpack with that question.
Yes.
I would say that the state of the market today is, I feel like it's coming more into balance. And what I mean by that is 2-3 years ago, there was a whole series of events, geopolitical conflicts, interest rates, inflation, led a lot of business sellers to become very nervous about the current state of the world. And many of them felt like their businesses were operating, doing well. And when they looked out in the greater atmosphere, they thought, well, why am I going to go enter something that seems so chaotic when things are going relatively well for me? I'm just going to sit and I'm going to, we've heard this a lot, wait for things to settle down. So I think the thing is with life is that you can only put off things for so long. So a lot of these sellers, would-be sellers, have been waiting for years to go to market, to transact, to try to come up with their exit strategy and their transition for their business. And so we've started to see in 2026 more of those sellers come out, express interest. And the really cool thing is they're being met with a very robust, well-capitalized group of buyers that are out there interested in transacting and growing their businesses. So it's not to say that everything's smooth and that things are going to entirely flip around, but I guess to summarize, I think we're seeing the supply of sellers start to come more into balance with the number of buyers out there. However, there still are more buyers out there than I think there are ready and willing sellers to transact.
Thank you. That's a great answer. You've seen kind of every different type of capital structure. When a business owner comes to Calder looking to sell, how do you approach deal structure? What creative techniques are we using to bridge those valuation gaps?
Yeah, I mean, deal structure is always a perennial interesting topic. So most sellers that initially approach us are not interested in seller financing. Many sellers approach us, especially those that are not familiar with this process, have not gone through a transaction before, and they really are afraid, and it's logical, they're afraid to take any risk in a transaction. They'll say, well, once I hand the keys over, it's out of my control, and so I want 100% cash at closing. I want certainty that I'm going to get all my money and be able to walk away. That's great. We would love for that to be the case. I think the issue is that you're dealing with a dynamic market. You're dealing with buyers that are assessing risk, and most buyers and most lenders actually warm up more to a deal and are more willing to approach a prospect and spend time, get to know it, be willing to make an offer if they feel that the owner has some flexibility regarding seller financing. So we usually coach sellers that even if they don't want to seller finance any part of the deal, they're really most likely to maximize the overall value of the deal, as well as have enough negotiating leverage to perhaps negotiate out any type of seller financing if they express an openness to that up front, right? So the whole theme is coaching them to be open to it in order for us to build a big market that's interesting. And once we have that market, they have a lot of choices, and they also have more negotiating leverage that we can use to try to make the terms better. Ultimately, deal structure is about mitigating risk, right? On both sides, right? So I think that you actually have the magic of the deal come together when both sides kind of properly understand the environment of risk. And I should say also, there are some things that sellers should be aware of regarding deal structure, because they need to be ready to be open to, not full cash at closing offers. If you have significant customer concentration, right? If you have 50 or 60+% of your business with one customer, it's very difficult to make a buyer secure in giving you a full cash transaction. And if they are willing to do that, chances are it's going to be for much less than you want, right? And what's the reason for that? It's simply because if that one customer falls off or goes away, a significant part of the value of the business is destroyed, right? And there are a whole bunch of other reasons too. I mean, there's key man risk. In some businesses, the owners have done a good job of working themselves out of the business, and some they are still intimately involved, working 50, 60, 70 hours a week. Clearly, buyers are going to view that involvement with different degrees of risk.
Thank you, Max. This probably feeds a little bit into the last question as well, but how do you assess whether a deal is worth pursuing? And then what are you seeing that is killing a deal early on?
That's another very nuanced question. So I'll take the sell side and I'll take the buy side separately. So because we take on a lot of sell side clients where we're representing sellers looking to find the best buyer, and we were representing a lot of buyers where these are buyers that are looking to find the right sellers, for their endeavors, their careers, their bolt-ons, etc. So when we first engage with a potential seller, our automatic, the way that we approach that is assuming that they are not well educated on the components of valuing their business, right? Now, some are very well educated and it's a pleasant surprise, but for most of them, they need kind of the education in terms of how our buyers going to look at their business, how our lenders going to look at their business. And so therefore we go through a very thorough valuation and financial pre-due diligence exercise with them. And so this typically takes a matter of 3 to 4 weeks where we're collecting a lot of their information about their business. So financial records, tax returns, operational issues, just really learning about the company so that we can, instead of taking on the intermediary's role, we can take on the buyer's hat, put the buyer's hat on. And then we put together a very thorough analysis for them, looking at a variety of valuation methods. And then we very transparently present this analysis to them. We walk them through all of our financial adjustments. We walk them through the valuation models. We walk them through all the data points. And the point isn't that we are right. The point is that these are the same types of things a buyer is going to do when they look at the business, right? And so we're trying to give these potential sellers an idea of what they're going to encounter once they get on the market. And if there's misalignment there, very simply, if the seller says, well, I need 7 million to sell my business, and we're saying it's probably going to be 4.5 to 5 based on all the data points, there probably isn't a lot of good use in taking 6 months of both of our time and going on the market to try to make something happen that's unlikely to happen. Instead, what we can do is we can help them understand with that data, where does their business need to be from a performance standpoint to achieve the valuation metrics, right? We talk to them about their deal team. We talk to them about their business operations. We try to just give them honest advice on where they could improve things, to achieve their goals. And we are not looking for the next, we are always looking for the next transaction, but we're not looking for the next transaction that's going to be forced or that's not going to align with what our client wants. So I would say that on the sell side is the most important thing, is aligning valuation, deal structure, process, buyer type, expectations, which we can do all up front with less than a month's time. On the buy side, to flip it over, there are a lot of buyers out there that are looking for businesses, and there are a couple things that we look at when it comes to buyers. First of all, is the focus of their mandate. So a lot of buyers out there will say, particularly newer buyers or less experienced buyers will say, well, I'm interested in all these industries, all these sizes of businesses at all these locations. And where I think that comes from psychologically is they don't want to miss anything. So they say we're open to everything. The problem is, how do you take that type of broad mandate and go start finding prospects? And then what story do you tell those prospects once you're on the phone with them or in meetings? Because if a seller hears, well, my buyer's interested in construction, distribution, manufacturing, 1 to 10 million EBITDA in any state, east of the Mississippi, that does not convey to that seller that the buyer has serious focus. And therefore, they're unlikely to be interested in pursuing that conversation. So we try to help buyers tighten their focus and their mandate up front. Of course, what else are we looking for from buyers? We're looking for available capital, right? They certainly don't need to have every dollar they need when we engage with them, but we have to have a reasonable idea of where the funds are going to come from, right, for these transactions. That's part of the story, right? We want to be able to go to sellers and discuss that we have a well-capitalized buyer. And I think there are other soft signs too that we're looking for. I mean, we're looking for professionalism, momentum, right? We're looking for people that when there is an opportunity, they pick up and they're ready to have the call, they're ready to have the meeting. They're not over-qualifying prospects out of the gate. There's a lot you learn when you just get in a room or on a phone call with an owner that you didn't know up front. And certainly our team is doing a really good job qualifying all these off-market sellers up front, but we can't ask them every question in 30 minutes, right? So looking for buy-side clients that are willing to engage and learn. I think lastly on the buy side, it is really looking for folks that are willing to write offers. I know it sounds a little strange to say that, a buyer would engage you and not write an offer, but getting to that offer stage is a critical stage for buyers. And sometimes they get overwhelmed with, are they making the right offer? Are they going to offend the owner? And they almost get their hands tied. So I think the last thing on the buy side would be a commitment to a 6-month period. We're asking them to commit to working with us for 6 months. If they're unwilling to do that, then it's probably not a good fit for us. The name of the game up front with sellers and buyers, let's take a few weeks up front to make sure that we're aligned on the criteria and the expectations of this process. Because if we'll be very honest with them what to expect, but they sometimes have never been here before, so they don't know what to expect. So just making sure to do that up front makes it very smooth when we're actually on the market.
Makes a ton of sense. Are you seeing any shifts in buyer and seller expectations as in this current, time frame?
That's a great question. So, I always have a lot of conversations with sellers and buyers, but it's hard to know whether I'm having enough conversations to get a good sample size, right? It seems that there's a theme right now where there are quite a few like tech and AI-enabled software companies or tech-enabled service companies that are trying to position themselves for extremely high sale multiples that are probably unachievable in the market. So recently I've had conversations with folks that are doing, 500 or 700 or $1 million in EBITDA, and they're expecting like an 8, 9, 10 multiple for their business. And unless it's a unicorn, that's probably not going to happen. So that's a tale as old as time. Many sellers think the business is worth more than it is. Another reason to go through that qualification process up front. And I think with buyers, I think you see tightening mandates. I mean, AI and tariffs have really caused buyers to focus in on, for example, what type of services are going to require licensed or certified people to be out in the field doing something. That we're seeing a lot of focus on that. So, and you could say the home service is there. So HVAC's been hot for a while, but roofing, environmental services, decking, siding, landscaping, facilities maintenance, these are fire protection. These are all industries where we're seeing a ton of interest. So for those owners that started those types of businesses 30 years ago, the time may be now. So
makes a ton of sense.
And I would say lastly on that note, buyers, there are a lot of buyers, but gone are the days of like all cash deals and minimal due diligence. I'm not saying that those things can't exist separately, but combined, those are kind of going away, right? Buyers are intensely scrutinizing sellers right now. And I think because of all the risk factors that are perceived out there, they want to make sure what they're investing is something they feel they can grow without worry of all these monsters lurking in the shadows.
Sure, that makes a lot of sense. Tapping a little bit more on the buyer side. So, Calder works with a wide array of buyers, PE groups, family offices, strategics. How have you seen PE evolve in the middle market, and what should owners understand when they're choosing between a PE buyer or a strategic one?
That's a good question. Private equity has evolved a lot and become prolific over the past 20 years since I've been in business. When I started in this industry in 2005, PE really wasn't a big factor, and things really didn't talk about PE a lot. Now it's every conversation there, and PE's been coming down market too. So looking for bolt-ons. Usually very professional, very aggressive, very intelligent, sharp groups. And I think a couple things to think about versus strategic, so that a private equity buyer is typically buying, and they don't necessarily have people in place that are just going to come in and run the business, right? So they are much more interested in ownership and management teams, rolling equity, being ready for that second bite of the apple, but they want them to stay. Because again, they're trying to consolidate maybe some financial items, and they're really leaving the business to operate and provide resources and benchmarks and guidance to it, while they go and they acquire more so they can eventually, yes, sell it up the food chain. So a lot of owners have a negative view of private equity. And I don't think some of it's deserved, some of it's not deserved. All right. And a lot of it's circumstantial based on deals that have happened. But ultimately private equity is, what are they doing? They're taking money from investors. They're trying to buy things. They're trying to make it better, and they're trying to sell it to return money to their investors. Right. And it doesn't mean that they're just laying down the hammer and making everyone's life difficult, but you can expect that it's going to be more tightly run generally than it maybe was before, right, with private equity ownership. And they do want to align incentives. So they want to align the incentives of the previous owners, the incentives of their investors, the incentives of the employees. So I think generally private equity are very good operators of businesses. And I think that to a certain extent, a business can retain a level of autonomy through private equity acquisition versus a strategic. So if you think about a pure strategic buyer, they may be willing to pay the highest price, but that's often based on cost synergies and reduction of overhead and certain people. And they might not want the previous owners to be part of the business, right? Because they have leadership already established, right? So I think there's a myth that strategic buyers are always the best buyers or the top payers. I think it just depends on the situation. It also depends on what does the owner want for the future of the business, right? Oftentimes, small strategic buyers are the lowest payers because they don't need it, right? They'll buy it if the price is right.
Right.
So a lot of things to consider there. And I mean, we haven't talked about individual buyers either, or entrepreneurs, but they can oftentimes be a really good way to continue the culture and the legacy of the owner as well. So, and they can often pay very strong prices.
That makes a lot of sense. Are you seeing one buyer kind of coming ahead in most deals that are closing currently?
It depends on it's just going to depend on the type of deal and the size of the deal. I mean, again, if you're in one of those like home services, or if you're in one of those technical people going out in the field and performing something, we're seeing private equity mandates really hone in on those types of services. And generally speaking, if PE is if they're looking to bolt on to their platform, they are often willing to pay more than you might think in order that they get that opportunity and their competitor doesn't get the opportunity. And the very simple analogy would be, well, maybe a fair market multiple would be a 5. They might be willing to pay a 6 because they're going to sell for an 11, right? And so they don't want to, but if you make them feel competition, they will pay more.
It's interesting.
Yeah.
Very interesting. Looking ahead over the next couple of years, are there any major shifts that you can predict or maybe kind of see the writing on the wall coming in how deals are executed?
I think the silver tsunami has been a silver trickle. I feel that that's picking up some steam. I feel like just from a age perspective, demographic perspective, many of these owners have to do something in the coming 5 to 10 years. We don't see many businesses that are operated by folks that are 80 years old. Sometimes we do, but there's increasing amounts of businesses that are operated by folks that are 65, 75 years old right now. And it's just, they have to do something, right?
Yeah.
Many of them have not planned well, but still have very saleable businesses. So I see more sellers coming to market. I don't necessarily know that price and valuation alignment are ever going to be solved, right? I think it's going to continue to be a challenge. Sellers always want more, buyers always want to pay less. It's just a simple fact of life.
Yeah.
I think on the buyer side, entrepreneurship is becoming very trendy. I don't exactly know what I think about this. I'm a big fan of entrepreneurship in general. One of the reasons I'm in this business still is because I love working with entrepreneurs, whether buyers or sellers. And I think entrepreneurship is the backbone of this country. So I'm encouraged by that jolt of entrepreneurship going through the United States right now. However, it's not for everyone. And so there'll probably be a lot of mistakes that are made out there, right?
Yeah.
But I think that what that means is deal activity will continue to pick up. It should, barring some catastrophe, well, which those are always looming in the shadows somewhere. There's kind of a lot of discussion right now about some of the extended hold periods for private equity. I don't necessarily know how that shakes out. Some people are predicting private equity companies will be mass shedding these orphans or closing them. I don't necessarily think that's true. So I don't know how that's actually going to shake out. And some people are also predicting that it'll mean there'll be less ease with raising funds in the future because investors aren't seeing the performance that they were led to believe would happen. I doubt that, because I think that 20 years ago, it was unique to have your wealth advisor say, hey, we should allocate some of your net worth to private equity. That is no longer unique.
Yeah.
Now private equity is coming down to like the Main Street investor. And people, frankly, are sometimes a little bit more excited about investing in private business than they are in big public companies that just seem like behemoths that you have no influence over, right? So I think, just like I like working with entrepreneurs because it feels real. I think private equity feels a little bit more real than investing in, the S&P index, right? Yeah. So people are, especially business owners that have accumulated a lot of wealth, they tend to be pretty opportunistic and they'll take a chance. So
yeah.
I think money's going to continue flowing into private equity. That's what I think.
Yeah, that's interesting. I mean, it'll be really interesting to see how it kind of all shakes out, and there's never a dull day. So.
Yeah. Well, the lower middle market is forever interesting.
It is. So switching gears a little bit, kind of interested for students and young professionals that might be watching, what's one piece of advice for building a career in deal making?
Yeah. It's interesting. When I got into small mergers and acquisitions over 20 years ago, I somehow found my way in and I fell in love with it. It's interesting. There seem to be more formal paths forming towards getting into investment banking, but really there aren't really a lot of programs out there to train you to get into this business. So really the biggest advice I could give is to fight for internship opportunities. If you're a finance or accounting, econ major and you're interested in investment banking or think you are, just fight to get internships into the business, because that's kind of the way that you build your career into it. And I'd say, once you're in, my biggest advice to university students would be to be curious and ask questions and put your hand up. Because when you're in school, you're basically evaluated on what you know. But when you get into the workforce, particularly as a young person, you're really more evaluated on what you don't know, but how curious you are at attaining that knowledge. Right?
Yeah.
And so to come into, I see mistakes sometimes the interns make coming into our business and acting like they know things. Yeah. Just don't act like you know anything and just learn.
Yeah.
Right? So that would be the biggest advice, is put your hand up. And AI can't put its hand up, and AI can't, at this point understand the soft side of things, can't read the room, right? So
yeah.
A+ people will always have a place in our world. Always.
They will. Yeah, that's great advice. I definitely agree with that. I have one more question for you. What is the most important lesson that you've learned from a deal that didn't go as planned?
This one's interesting. Probably 6 or 7 years ago, so we'll be 13 years old this year. 6 or 7 years ago, we had our first client where the client terminated the deal, like just shut it down, said, we're terminating our agreement with you, Calder. And we thought things were going well. Like we were introducing buyers, talking about offers, and it just felt so strange. It was a feeling. It felt so strange. So we kind of tried to follow it along a little bit in the ways that we can. And sure enough, we found out that the buyer and seller, or our seller and a buyer, basically went around us and did the deal, right?
Wow.
And we reached out to them, tried to have a conversation with them about what happened. And, our agreement that we have with our clients does not allow them to go around us, right? And so tried to have a conversation, but the other side was just not receptive, just unwilling to talk. And so I was faced with a decision about how to proceed, right? And do you just let them off, or do you go after them, right? And so I kind of stepped back and reflected and realized I have a whole team watching me right now, right? And so I have to stand up for what our principles are, right? And it's not to be pushed around or taken advantage of. So we pursued that company, and it was basically my lesson in how litigation worked, right? And I don't have any regrets. I don't. I'm glad we did that way, and that is the way we'll always do it, because the market will realize how to treat you, right, by your actions. And so if your actions are just to fall over, then you're going to be taken advantage of. And I think that was a really good lesson. And I don't mind talking about that with the team. I don't mind talking about it with other people. I think a lot of people are uncomfortable talking about suing and litigation because it is uncomfortable, right? But if it's for standing up for what's right, then I have no issue speaking honestly about it.
Yeah. I think it's a good principle to share with the team as well. So,
I mean, getting good at litigation is, I don't know, you don't hear a lot of people say that that's something that they're happy about, but
yeah,
I think, when you get to our size, you're going to just run into people that decide who they're going to pay and who they're not going to pay.
it's true. Yeah,
So it's unfortunate.
it is very.
Well, thank you for the thought-provoking questions. I really enjoyed thinking about them and answering them.
Yeah, thank you for taking the time. It's been fun.
Thank you all for your time and attention. And if anything that we said was interesting or thought-provoking for you and you have questions, feel free to reach out. You can reach me directly at max@caldergr.com. You can also visit our website, caldergr.com, and inquire on any of our opportunities, or fill out our general contact form. And you can be assured that anything that you submit is treated confidentially. Thank you.